Have you ever pondered the role liabilities play in finance and investing? Well, you're not alone. Liabilities, in the simplest terms, are legal obligations or debt that one owes to another person or company. They're like financial promises that must be fulfilled. In the world of finance and investing, these liabilities carry significant weight. Just as assets can boost a company's financial standing, liabilities can weigh it down. They're like the mirror image of assets. While assets add value, liabilities subtract it. Understanding them is crucial because they directly impact the overall financial health of a company or an individual. They're not just numbers on a balance sheet. They tell a story about a company's financial obligations, its debt, and how it manages its resources. They provide crucial information that can guide decision-making and investing. Now that we've grasped the basic concept of liabilities, let's delve deeper into the different kinds of liabilities. Scene script. Imagine you are a business owner. What are some of the immediate financial obligations you might have? Let's dive into the world of current liabilities. These are the financial obligations that a company is expected to pay off within 1 year. They're called current because they are usually settled within a short period, typically the operating cycle of a business or a year, whichever is longer. Think of it like this. If your business were a ship, current liabilities would be the water that needs to be bailed out regularly to keep the ship afloat. They're the ongoing day-to-day obligations that keep the wheels of commerce turning. One of the most common types of current liabilities is accounts payable. These are the bills that businesses need to pay to their suppliers or vendors for goods or services received. It's like when you go out to eat and get the bill at the end of the meal. That's an account payable. Another type of current liability is accrued expenses. These are expenses that a business has incurred but hasn't yet paid. For instance, if your business has employees, you might have accrued expenses for their wages or benefits. These are costs that have been incurred, but the cash hasn't left your bank account yet. And then we have short-term loans. These are borrowings that need to be repaid within a year. It's like borrowing money from a friend and promising to pay it back in a few months. But in the business world, these loans often come from banks or other financial institutions. Remember, current liabilities are not inherently bad. They're a normal part of doing business. However, a business must manage these liabilities effectively. If the current liabilities grow too large, it can cause cash flow problems. It's like having a leaky bucket. If more water is coming in than going out, eventually the bucket will overflow. So, current liabilities are short-term financial obligations that need to be prioritized by businesses. Managing these liabilities effectively is a crucial part of maintaining a healthy financial position and ensuring the long-term success of a business. What about financial obligations that extend beyond a year? How do they affect a business's finance? Let's delve into that. This brings us to long-term liabilities, a category of debts that are due over a more extended period, typically beyond 1 year. These aren't the short-term bills or immediate expenses. These are the big-ticket items that a business has committed to pay over a more extended period. Think about it like this. If a company is a ship, then long-term liabilities are the heavy cargo that it has to carry across a vast ocean. It's a commitment, and it's not something that can be easily tossed overboard when the waters get choppy. One of the most common examples of long-term liabilities is bonds payable. These are essentially loans that a company takes out from investors. The company promises to pay back the loan with interest over a set period. It's a way for businesses to raise capital, but it also becomes a long-term obligation. Then we have lease obligations. When a business leases a property or equipment, it commits to making regular payments over the lease term. These payments become part of the company's long-term liabilities. Another important kind of long-term liability is pension liabilities. If a company has promised to pay pensions to its employees after they retire, those future payments become a part of the company's long-term liabilities. These liabilities often involve larger amounts and can significantly impact a company's long-term financial stability. The company needs to ensure it has the capacity to meet these obligations when they fall due. It's a delicate balancing act, a test of a company's financial strength and management prowess. So, when we talk about long-term liabilities, we're talking about the future. We're talking about the promises a company has made and its ability to keep those promises. In essence, long-term liabilities are commitments that require careful financial planning and management. They are promises to be kept, obligations to be met, and a testament to a company's long-term financial health. Can potential financial obligations also be considered liabilities? Absolutely. Welcome to the intriguing world of contingent liabilities. These are potential debts that hinge on a future event occurring or not occurring. They're like the Schrodinger's cat of the finance world, existing in a state of uncertainty until the moment of truth arrives. Interesting, right? Let's delve deeper into a few examples. First off, we have pending lawsuits. Imagine a company tangled in a legal dispute. Until the verdict is delivered, it's uncertain whether the company will have to pay damages. If they lose, it could result in a significant financial obligation. But until that gavel drops, it's a contingent liability. Next up, we have warranty obligations. Picture this. A company sells 1 million washing machines with a warranty. If a significant number of these machines break down within the warranty period, the company might face substantial costs for repairs or replacements. These potential costs are, you guessed it, contingent liabilities. Then, there are potential fines. Consider a company that's under investigation for regulatory violations. If found guilty, they might face hefty fines. But until the investigation concludes, these fines are, yet again, contingent liabilities. Contingent liabilities, despite their uncertainty, are not to be taken lightly. They may not be concrete obligations right now, but if they come to fruition, they could significantly impact a company's financial position. They could lead to unexpected outflows of resources, affecting profitability and solvency. It's like a dark cloud looming on the horizon. It might not rain, but if it does, you better have an umbrella ready. This is why companies must adequately manage these potential risks. They need to estimate the likelihood of these events occurring and set aside resources accordingly. In a nutshell, contingent liabilities are like ticking time bombs. They might not explode, but if they do, they can leave a sizable crater in a company's balance sheet. As investors or financial analysts, it's essential to keep an eye on these potential liabilities. They might just tip the scales when making investment decisions. Contingent liabilities, although uncertain, can pose a significant financial risk if not adequately managed. How do these liabilities influence your decisions as an investor? It's a pertinent question, isn't it? Let's delve into this a bit further. First and foremost, understanding a company's liabilities can provide a clear picture of its financial health. Just like a doctor uses a stethoscope to listen to your heart, liabilities serve as a tool for investors to gauge a company's financial heartbeat. A company with high liabilities might be struggling to keep its financial health in check, and that's something you, as an investor, need to keep an eye on. Liabilities can also be an indicator of the risk level associated with investing in a company. A company with high liabilities, especially long-term ones, might be riskier. Why? Because they can eat into the company's profits in the long run, leaving less money for shareholders. It's like a leech that slowly drains away the lifeblood of the company. On the other hand, a company with fewer liabilities and more assets at its disposal could potentially be a safer bet. It's also essential to consider the nature of the liabilities. For instance, contingent liabilities, those sneaky little gremlins, can suddenly become real liabilities affecting a company's bottom line. They're like a ticking time bomb, creating an element of unpredictability. But don't let this scare you away. Liabilities in themselves aren't necessarily a bad thing. They could be a sign that a company is investing in its future growth. It's all about balance. A company with zero liabilities might not be taking the necessary risks to grow. To sum it all up, understanding a company's liabilities is like reading a map. It can guide you towards making informed investment decisions. It can help you assess whether a company is sailing on calm waters or heading towards a financial storm. Remember, investing is not just about finding diamonds in the rough. It's about avoiding the rough altogether. So, always keep an eye on those liabilities. They can be your compass in the world of investing. A wise investor always takes into account a company's liabilities before deciding to invest. So, what have we learned about liabilities in finance and investing? We've delved into the various types of liabilities and their implications. Current liabilities, for instance, are obligations due within 1 year. They influence liquidity and are crucial in evaluating a company's short-term financial health. We then moved on to long-term liabilities, which are debts that are due beyond a year. These can significantly impact a company's capital structure and future profitability. Our discussion then brought us to contingent liabilities. These are potential debts that could occur depending on the outcome of certain future events. The uncertainty around contingent liabilities can pose considerable risks for investors. We've also understood how these liabilities can shape our investment decisions. Knowledge of a company's liabilities allows us to gauge its financial stability. thereby guiding us in making informed decisions. Remember, understanding liabilities is not just about knowing what they are, but also about understanding their impact on financial health and investment decisions.